So, good evening, everyone. I am Dr. Shweta Matreja, your host for today, and it gives me immense pleasure in welcoming each and every one of you to our second live session of Step 1 course. Together, let us continue this empowering journey of financial enlightenment, one that aims to make every participant financially independent, informed, and secure. Without further ado, it is my absolute honor to invite none other than the visionary founder of WealthCon and Nest Life Research, Dr. Ram. Over to you, sir.
Thank you very much. Namaskar and happy Diwali to everyone. Today we are going to discuss the live demo and we'll discuss how to select the mutual funds. As you are aware that whatever we discuss is only for the educational purpose. Do not consider this as investment advice, and whatever the mutual funds which will arrive at the end of analysis, don't consider this as a recommendation. So far we discussed about types of mutual funds. In the journey of investment, we need to understand financial instrument, then strategic principles and logistics of buying and selling that financial instrument. For example, here in case of mutual funds. Okay, so we have discussed a lot about financial instrument, that is mutual funds. Today we will start a discussion about a strategic discussion where we will start discussion of how many mutual funds and how to select mutual fund for a particular goal. That we call it as a strategic principles. And the logistics means how to buy and sell. I demonstrated ETF buying in one of the videos. I'll make another video to buy on the MF Central and Coin as well. Okay, it's a very simple process to buy mutual funds and sell via aggregators. There is one video also to open how to open MF Central account. So write down. You can have a Coin or MF Central or MFU, any one of them. You don't have to, if you are using Zerodha Coin, it is not absolutely mandatory to open the MF Central, but it is good to have two different sources. That's where you can have in a non-demat format mutual funds as well. So there is no extra cost to opening the MF Central account. So better to open that. We discussed that investment means investor plus instrument is equal to investment. You cannot consider investment just because of instrument. It has to match to the investor's target. What is target? Time horizon, age of the investor, risk tolerance, goal, expertise, tracking the market. So I'll give you a brief. If your time horizon is more than 7 years, that we consider as a long term. If it is less than 1 year, we consider as a short term. And 1 to 7 is intermediate. And depending upon the financial instruments can be selected. For age, what is the implication of the age? Senior citizen can invest more into the debt product and less in equity. Young person can invest more in the equity product because they have enough time to tackle the volatility of the market. Then risk tolerance. Now here it is a psychological phenomena. Unless you go through market phase where your portfolio is in a red, so I call it usually a red tolerance. That means how much portfolio, red portfolio you can bear. And as per our research, maximum investor, retail investor cannot hold a position if portfolio is down more than 50%. So even someone saying I am ready to take a risk, but as soon as market goes 30, 40, 50% down, retailers tend to lose the patience. Now here we'll have two categories. One is I am not, the person will say I don't want to take risk, or other person will say I can take the risk. That's it. There is nothing called as moderate, aggressive, because if you are taking the risk, you cannot calculate or understand unless you go through that phase. Then goal of investing, that decide the mutual fund type. Expertise here in mutual fund case, expertise is minimal. Whatever you are discussing at step 1 course is more than enough. Tracking the market, this is a passive investing so that you don't have to track market every day. So this formula is for all financial instrument, including shares and etc. So let's start a strategic principle discussion. Now, you remember act of God when you try to understand or learn the mutual funds. I started discussion act of God. Okay, act of, it is not act of, it is act of. But easy to remember. This God, this, it has to be growth, it has to be open-ended, it has to be direct. Period. You don't have to ask counter parties, income distribution, capital withdrawal. That is of no use. What is important here? Active or passive investing. We invest in both. So no question of fighting. Category, there are three main categories: equity, debt, hybrid. Hybrid is the combination of both of them. So main is equity and debt combination. These are two types of assets, and hybrid is just a combination. Then according to tax rate, we can have three categories: DEM. I told you, remember Damat. Here, debt fund are taxed as your slab rate. Okay, it means your salary income, your rental income, interest income, dividend income, and capital gain of debt product. Okay, it will be clubbed together and it will be taxed as a normal rate. It is called as normal rate. Then equity, that is special rate, where there is 20% for short term and 12.5 for long term if you hold for more than 1 year. Why these categories are important? Because whenever you exit, there is a tax incidence. So you have to plan in such a way that you will not have more tax incidence, or at least you know. And then there is a miscellaneous category where if you sell within 2 years, there will be slab rate, and after 2 years, special rate. Okay, this is very easy to remember as well. Today we are going to discuss about three objectives. I explained this as well. There can be mainly three objectives of mutual fund investing. One is parking of the money. Second is protection and growth. So let's discuss one by one. Now, when we started discussion, we discussed all categories, everything, because when you are learning, let's say here, you have zero knowledge, you learn, and so complexity increases as you learn. But thereafter, while you do the actual investing, you don't have to do everything complicated. You just need a simple things. Then you may ask, then why did I discuss all of the things? Because you are learning, and this is the once in a lifetime. You don't have to learn every time. Once you understand basic, thereafter it just updates. Till date, we discuss all the categories. Now I'll discuss based on the objective, and I'll enumerate which are the categories important for you to achieve your objects. These are very simple as such. See, first, if you want to park money, these are the two categories which are more than enough, and this is liquid ETF. Understand the difference between liquid fund and liquid ETF. Liquid fund is unlisted, ETF is listed on stock exchange. Otherwise, by return wise, risk wise, all are same. All of them give return between 5 to 6%. Okay, less than 6% usually. When you are parking the money, your aim is not to get too much extra return, and you don't want to take any risk as well. Okay, it is just short-term parking. We say less than 1 year. If your time horizon is less than 1 year, then arbitrage, liquid fund, or liquid ETF. That's it. You don't have to look too many categories. Okay, so here is the arbitrage. Arbitrage is a very interesting category. It is an exceptional. Why? It is classified under the hybrid. Price behavior is like debt fund and tax like equity. This is it's a phenomenal exceptional case where you will find arbitrage fund under a hybrid. Price behavior is like debt, where there is no price fluctuation or not much standard deviation, and tax like equity. Okay, an objective of arbitrage fund is to park fund. So let's go and start selecting the arbitrage fund. So I'll go on the value research online. There is one more website, morningstar.in. This website can be also used. So let's start the arbitrage. Okay. So here we will go top down. That means we'll start with the category and try to find out best fund among that category. So you write down these steps, or when you watch this video, you can do live, so that you will have to practice. Okay, first you select home page. When you click over here, value research online, home page will open. Thereafter you go down. There is a lot of clutter here. Let's go fund screener. Write down fund screener. Second step, I recommend to write down the notes so that you can do yourself when you do. Third step is to go fund category. By default is here equity. You reduce that and go to the debt category. Select on arbitrage. Few more points you want to select are the open-ended, closed-ended. Any we don't want. Only direct plan, regular plan we are not interested. Okay, and here it will be active only. Most of the passive investment, as anyway they are not there in a arbitrage fund. Now I selected. There are 35 funds. How many funds you want to select? Maximum 2. Out of 35, 2. How to select? Next step, write down these steps. We are going top down. So we went first category. Next, these are the sequence you have to next go and click on the point to point return. Here start date on January 2020, before COVID. Now you may ask why? Because we want to capture any problem or any abnormalities happen during the COVID as well. 1st January. And you can select end. So this is point to point, in which we are deciding both points. Difference between point to point and trailing is, in a trailing we are decide only ending date, and automatically software take the previous 5 year, 3 year, 2 year, 1 year. Here point to point we are taking 2 points and just select. What will happen when we apply this? Some of the funds which are recently launched will automatically eliminated. Now we have only 23 funds. Out of 23 funds, we will select 2. So go down here and check point to point return here and write down the names of top 5 funds in your notebook. Okay, first write down 1, 2, 3, 4, 5, even 6. Okay, next step is to go to the risk, click on the alpha, and see that in case of here equity, this is equity, so alpha should be more than 1, right? Write down the whichever that are having more than 1 alpha. Then click on the short tonnage ratio. It should be more than 1. Okay. So now you see data arbitrage, Kotak arbitrage. These names are Invesco coming repeatedly again and again. Then go to the return. Okay. Here, although SIP may not be useful in this case, but sequence is this. After risk status, go to the SIP return. It is in the return. Click on the 5 years. We select 5 year, 3 year, 1 year. 1 year is in this snapshot. Let's go first 5 year and sort the data by 5 year. So you can see here there are 24 funds. When we are selecting the funds, remember one principle here. Now I'll show one image here. So here when we find the made for the marriage matrimonial site, we select best among the all option available. Okay, this is the principle where you will use best among the available options. So the way matrimonial sites are also have multiple criteria, exactly same criteria like class, caste, income, education, all. Similarly, here we'll also use the same principle where we go top down from all option best two, mutual fund two, marriage one. Okay, all right. So here you will see that this fund is top in the 5 year, in the 3 year as well. Okay, here this is also, this is the rank as well as return. Okay, it is in the top. Okay, you select, go on again, long term return. So this is XIR return, this is trailing return. Okay, so we started with the point to point return, then we went to the XIR, then we went to the long term trailing return. So sequence is point to point. When we selected point to point, we point to point, then SIP, then trailing return, and then rolling return. That I'll discuss later on. In fact, I discuss it. So while doing the return parameter, these are the return parameters. So here is the again, these are the return parameters. These are risk stats. And when we check the expense ratio, we'll also check at the time of investing that expense ratio should not be more than 1. But while screening, expense ratio, here you'll see the expense ratio as well. In a snapshot, there is expense ratio. If you go here, expense ratio. AUM also there. All parameters are there. Where you select the fund more than 5 years and top giving the more return and less risk as well. So here, which mutual fund you will select for the parking of the funds? 3 year. So this 3. Now this is homework to you. Do the analysis of these 3 mutual funds. Okay, by going and finding out their standard deviation and all, expense ratio, and select whichever you want. Okay, by return wise, there is not much difference. What will be the difference is risk and all the things. So this is arbitrage fund. Let's go to the another category, liquid funds. Liquid funds are in the debt category, where we see the debt category, liquid fund, and select 58 funds in the liquid fund category. Go to the point to point return again. So when we do the point to point return, automatically the short age funds will automatically eliminated. Now see, this point to point return is from January 2020. Okay, from here only you can find out that which has given more return. As such, this liquid fund arbitrage return is not too much significance, hardly 1 or 2%, but among them, which is the best, taking the consideration of fee, expense ratio, risk, and so on. Let's go to the risk and find out alpha shortage ratio and write down this. Okay, so you can write down these 4 names, 4 or 5 names, which are giving positive alpha, and check whether these are name repeated on there as well. Okay, next criteria as well. Okay, can take this as well, top 5 on the alpha. Select in the top whether they are same in the shortness as well. Then go for the return. Next is SIP return. In this case, SIP return is not relevant because of anyway your price does not fluctuate. SIP is very useful only when the price fluctuates, and we call this as a rupee cost averaging. But nevertheless, we can do the sorting. What happened here? Value research online has got, it was hanged. I'll restart again. So when we select the 2 mutual funds, we select whichever giving consistent return with less risk. So arbitrage and liquid fund risk status and standard deviation is more or less So I will go to the next category of, so parking of funds selection is as such very simple. In ETF, there is a liquid case. So it is just a matter of convenience, small here and there, but arbitrage, liquid funds, and liquid case or liquid ETF. These are easy to select. Now, next is selection of debt funds for the protection of the capital and to beat the inflation. How many funds you need? Two only. You don't have to have too many mutual funds. If you want to ask how many mutual funds should be in portfolio, you can remember as a cricket team, not more than 12 player. Okay, it is a maximum 12. So, and this is not for the, let's say someone has the objective just for the growth, then he may not need the debt fund, right? If someone does not want too much growth, then he can have and he can reduce one or two from the equity segment. So this is a debt and this is equity. This is for the growth purpose. So write down this thing. So this first is for the parking of the funds. This is for protection, and this is for the growth, PPG. How many funds? Two are the more than enough, because too many funds are not necessary. I'll show one debt category. Go to the fund category here, and which category under the debt. So here, now here your aim is capital protection. Okay. In that case, you can invest into the money market or gilt fund. It is called as government bonds. So write down, when you are investing into the debt funds, that debt fund should invest into the government bonds and corporate bond, which has a triple A rating. Okay. Now, the way hotels have five rating, like 5-star, 3-star, 2-star, there is a rating system for the bonds as well. Too much is not necessary. Just remember triple A rating and government bond. Then B, C, don't go into that risky bonds, because if you want to make the return, then why to take risk in the debt products? So debt products are for safety, not for the increasing the too much return. So all these are not necessary. So long duration is also not necessary. Medium is not necessary. What you can do, invest into the low duration, ultra short, money market, and gilt. That's it. And you select one or two amongst them. Same funda. Go to the point-to-point return. These are the debt funds, and you see that highest return is 7.9 and lowest is 5. It means it is slightly better than the FD. That's it. Then same thing we use, go to the risk stats. Again, that alpha, standard deviation, and all the things. Okay. Find out positive alpha, more than one alpha, more than one certainty ratio. Make a list who are the topper. Go and find out who are the topper in the trailing return, SIP return, and keep those who are in a topper. Okay, that's it. It is not too much complicated. Just to find out which is topper and how much return that is giving. So this is for protection. Now I'll show one more category of hybrid conservative. Go and select conservative. So under the hybrid, which categories we use? Write it down. We use hybrid aggressive for the growth purpose. We use the conservative for the protection purpose. We use arbitrage for the parking purpose. Which one? This is for the growth purpose. Conservative for the protection purpose, and arbitrage for the parking purpose. Here return will be more than 10%. In here it will be between 7 to 8%, and here 5 to 6%. Which one? Let me write. Conservative, aggressive, hybrid. That's it. As of now, ignore all other categories. These are the only required under the hybrid category. So I'll explain about the hybrid category in the conservative here. If you click here and go and find it. Same principle, go and find out highest among the point to point return, highest among the SIP return, highest among the alpha, highest among the short-term, and low standard deviation, low expense ratio, and so on. It is the same sequence. You have to go in the same sequence every time. See the alpha. If you see there are hardly 5, 6 which are positive alpha. Check those return. Here you can see that Parak Parik, ICICI Pru, and this thing. So check the short-term ratio. Okay. Meanwhile, check the standard deviation here. Okay, just write. See, so standard deviation is between 1 and 5. That means low standard deviation. I'll compare with the equity as well. You can write down here the standard deviation of conservative hybrid conservative is between 1 to 5 because there is a debt component. So they are not too much volatile, and the senior citizen can use this for the retirement, holding the funds in the retirement, where they can beat the inflation. At the same time, they will get a slight higher return. Okay, how much return they can get in the conservative? Around 7-8%. So which is enough to beat the inflation, and there is not too much risk as well. Standard deviation you have seen that it is between just 1 and 5. So by return wise, we will check the return 5-year. Kotak hybrid is topper here, again topper here. You can see the rank as well as return. Even you can check in the SIP as well. 5-year SIP. This is coming consistently. Kotak debt hybrid. So let's click on this one hybrid fund, and you understand why it is called as conservative and what will be the asset allocation. When we do individual mutual fund, we start with the name and find out what is the year. Here it's a conservative, basically conservative, hybrid conservative, and we check the portfolio, how much is a debt product and how much is equity product. By looking at first is, remember, DEM is debt more than the 65% yet. So this is a debt product. So in this fund, there is 75% debt component and 22% equity. That is the reason it gives some return than purely debt fund. If you go down here, you see that investing is mainly in the sovereign, means government bond, and AAA. Okay. If you see anywhere B or C, that is not good fund. These are bonds. Okay, this is bond, this is bond, this is bond. One more thing, you can see that here YTM, it represent indicative return. So it is more than 7%. So this category, hybrid conservative, can be used for the protection of capital. Although it is not completely risk-free, that means there is a drawdown. That means let's go one more point, understand drawdown and risk. So if anyone invests into the hybrid conservative, we have to check the different parameters. Which are the parameters for the risk analysis? Standard deviation and drawdown. Okay, these two are important. Out of this, drawdown is more important. I'll show where to look for the drawdown. Drawdown means price goes down and goes up again. So click on the return, go down here. On value research, you see the worst period and best period. Check for the worst period. So you see that in a COVID period, this fund went up to minus 11% down from within 1 month, from 23rd February to 23rd March. And you can check year-wise as well. Okay, so this is where you see the drawdown. If any fund is more than 40% drawdown in this COVID during the COVID month or COVID year, this is not COVID, but here was the COVID. So then it is little risky. So drawdown check. For the protection of the funds, drawdown should be less. It should never be more than 20 or so. One more, then there are your risk stats. You check the standard deviation as well. How much will be the standard? So for the risk analysis, remember two things, which are two: standard deviation and drawdown. A drawdown I did shown you. When you see the multiple funds, you will understand the drawdown pattern. Which funds has more drawdown? So here also standard deviation is 5. So less than 5 is acceptable. Drawdown should not be now 10, 11, okay. But more than 20% drawdown is not good for the protection of the funds, okay. 5 to 10% drawdown is okay. So I covered two categories for the parking of the funds. Now let's go for the growth ETF. There are 200 and more than 200 ETF, but out of which the most old are these two. So in ETF, there is not much to check. Only you have to check is the expense ratio and tracking error and tracking difference, which I mentioned in the one of the videos. Then I'll show one mid cap and small cap. Okay, every time it is the same sequence. Write down the mutual funds you are investing in the chat box. 10 seconds. Then we can write down the mid cap mutual funds. All right. See, remember this sequence. Yes, take this snapshot or paste somewhere. Go in the same sequence. These are the parameters for analysis. So now let's go to the category of mid cap and find out two good mid cap mutual funds. Same pattern you will use for others as well. Go to the screener. Go to the category here. Select mid cap. Where is the mid cap? Mid cap. And you want only direct. So we can exclude the direct regular here. Regular is excluded. Applied. How many are funds in mid cap? 39 as of now. Then what is the next step? Can you guess? Go and click on the point to point. So this point to point will eliminate the funds which are very new. So at the beginning, how many were there? 39. Now apply. Now only 8 funds remain. So now your life is so easy. You have only 8 funds which are more than 6 years. So just find out which are the best among them. Okay. So now I say Quant, Nippon, and Invesco. Okay. And automatically the net asset will be, see the criteria here, net asset, age, expense ratio are fitting in this. Then go to the next step is, what should be the next step? Go to the risk stats, alpha. Okay. So now there are only 14 funds out of which you want only 8 funds out of which you only 2. So those who are giving more alpha, those having more certainty ratio, keep that in mind. You can keep these 2 funds in mind. Invesco, HDFC, Kotak, ICICI, Axis, and go and check the return as well. Now here SIP will be very useful. Where in equity fund, SIP will be useful criteria. Now select here. So who is topper here now? Nippon, Mahindra, ICICI. Okay, Invesco. 3 year who is topper again? Kotak, Nippon, ICICI went down. Now Nippon and Kotak are still there in the game. Go and select here. Find out here. Nippon is still there. ICICI again came back. Quant is coming back. So Nippon is consistently there. 3 year. Nippon is in the top 3, 4. You can see this. Nippon, Kotak, ICICI. Now out of this thing, you can go and do fine tuning based on the rolling return or expense ratio. Now let's analyze. We selected multi-cap. Oh, it should have been a mid-cap, but anyway, the process is same. I wrongly selected multi-cap. Okay, so let's go back and select the. I'll select the mid-cap. See, process is same. Whichever only starting sequence, starting selection, everything remains the same. So now go to the snapshot and find there are 20 small cap funds. So which are the topper here? Quant, Nippon 1, 2, 3, 4. So remember this name. When you do, you have to do actually writing the names and find it out. Find out whether same names are proper. In the alpha, then short to noise ratio, quant SDFC, they are coming consistently up. Then go to the return and find out SIP return, whether they are again consistently in the top in the list. 5-year, 3-year. Okay, so the Invesco, Quant, Nippon, this is again come and they are coming top. And now you can see that definitely, see, this is Invesco is consistently in topper. Bandhan is also in a topper. Then you can go for the individual mutual fund analysis and find out their drawdown as well. Drawdown, how to find drawdown? Click on the return. Go here and see the worst period here. Now the small cap fund fell 36% in 1 month in the COVID era. You can say this period. You have to be prepared for such a drawdown. But when you invest for longer period, it should not matter to you. So now if you see the 5-year return, so eventually it goes up. Okay, slowly. This is price up and down is always in the equity. So this is how you select two mid cap, two small cap. You don't have to select two large cap, because when you do the ETF, these are already large cap. So ETFs are already large cap. So you don't have to select large cap mutual fund. And I believe that you actually don't need fund manager to select the large cap. Why? Because large cap are only 100 company, out of which mutual fund managers 60, 70 company. What is there to do the research? So no need to invest into the large cap mutual fund. Instead of that, you can invest into the large cap Nifty B, junior Bs. Mid cap mutual fund, yes. Small cap mutual fund, yes. Flexi cap, yes. Okay, these are for the growth creation. Okay. So let's take some questions. You can ask some questions. I think this was a small PPT which I finished. Okay. These are the same thing which we discussed. Okay. One more thing. Most important is this. This one. Please remember, selection criteria at the time of marriage is different than the divorce. What does it mean? When you are investing and making the list, you are finding the best among the category. But when you are exiting from the mutual fund, you are not selecting best of the from the category, because if you keep selecting best, then sometime your fund may not be in the best category. So what you have to do, whether your existing fund is performing at least above average or not. Okay, that should be the criteria. So that's what I say. Divorce criteria is different than the marriage criteria. In marriage criteria, we have a lot of things to check to find the best. But when divorce criteria, things are very easy. You just have to see whether performance is above average or not. That's it. Performance is above average or not. Even if it is not top, it's okay. Above average होना है, bottom में नहीं होना चाहिए. ठीक है? That's the criteria to exit mutual funds. How frequently? Once in a year, or maybe after 2-3 years. Okay. So this is the exiting criteria. These are entry criteria. Top down. Okay. The biggest question which many of you must be having, I will answer that first, and I'll take questions later on. How to convert regular to direct plan? How many of you are having regular plan? Now this will be the very problematic for you. First thing, you have to get convinced yourself. Please understand, I am not trying to convince to buy the direct. I am trying to tell what is right. I am not getting any commission from the direct plan. Okay, the person who is getting commission, he will try to give hundreds reason why to invest into regular plan. Okay, If you are convinced that I want to shift to the direct, then stop SIP of the regular plan. It is a first step. Sell regular plan in single day entirely, and within a 2-3 days, within 2 days you get money and buy direct plan immediately. Don't keep this money in a bank account or broker account. Buy immediately. Otherwise, we say that compounding will be not happen. You will lose compounding, etc. When you switch from regular to direct, write down. When you switch from regular to direct immediately, there is no effect on compounding. Whoever saying that there will be huge effect has the conflict of interest. What I said, immediate. That means next day or tomorrow or within 1 week. This word is important. Whether you should invest into the same mutual funds or new mutual funds. If your existing mutual funds are in a top category, then you can invest the same thing, or you can change. You can make your own list and switch. If direct name is not written in the name, then it is regular. Okay. If you see that your mutual fund, if direct word is not mentioned, that means it is regular. So mutual funds must have the direct and growth as a last name. First name is the AMC, second name is a category, and last is a God. Open-ended usually not mentioned, but GD must be there in your funds. Okay. Can you exit without telling agent? Answer is yes. You can just log in, or you can map your existing fund on the mutual fund central and just exit. Best is just to tell the agent that I need money for my function. I just want to sell everything. Now, what will be their defense? Okay, I'll tell you beforehand what they will tell you. Now, I am not against any agent. I'm educator. How to differentiate between educator and agent commission is educator try to give you knowledge and empower yourself. Agent try to force and sell, try to keep you in a loaded product, commission loaded product. So the first contention, they will say that there is exit load. Second, they will say the tax liability. Third, they will say that compounding will affect. Then it's a very complicated. How do I know? I am a mutual fund distributor, by the way. I got the AMP registration, and we miss the agents also get trained, and I am also trained in that how to tell client not to exit. These are the reasons. These are fully trained. डर दिखा दो, तुमको जमेगा नहीं, तुम्हारा लॉस हो जाएगा. For the loss, you will lose them. Okay, reality will be different. How to find reality? Suppose if you can offer your agent that take your advice fee every year. Let's say if you have 10 lakhs rupees, 10 lakh fund or 10 lakh portfolio, you can offer that I am ready to give you 5,000 as an advisor fee. Invest me into direct. He won't, because for 10 lakh portfolio, he getting 10,000 rupees. Why will you? So it's like even people are not ready to pay 5,000 for annual checkup to the doctors. So why can't someone for advice fee just once in a year? 5,000 is more than even 3,000 is more than. Okay. If your portfolio is 1 crore, you can offer that I'll give you 10,000 rupees or 5,000 consultation. He'll never agree. Why? Because here commission is 1 lakh per year. So there are a lot of conflict of interest. Okay. How these are not substantial? Because exit load is only after in 1 year, less than 1 year. And it is usually less than 1%. Okay. So even if you sell, an exit load is applicable, you are saving anyway is in commission. So that is not there. Tax liability. I'll show the calculation as well. Tax liability is always on the gain. And Whenever there is a gain, there is a tax, whether you pay now or afterwards. Okay. Second, compounding effect. It will never affect compounding if you try to switch immediately. For example, let's say you are going on a passenger train, okay, and there is a Rajdhani is coming on the same track. If you switch from passenger train to Rajdhani will move faster. Why it will affect compounding? Compounding will be affect only for the agent or advisor, because his income will stop. This is not at all complicated. You will not lose money by switching to direct to regular or regular to direct. Now I'll demolish the myth that you will have to pay the tax, more tax. Now here is a very interesting calculation. You write it down, you can do yourself as well. Suppose if you invested here, whatever the amount you invested, can you write your own? I'll take the same example. You write down the own investment and your current portfolio. Someone is asking, my agent frequently does switches out. See, be always remember, agent, distributor, advisor are doing their business. They have whatever they are doing is for their business, and there are a lot of commissions involved into this. So you write down invested and current in a single sentence. Then I can write here. You write two numbers, invested and the current. Then you will get immediately here answer. Total invested amount and current portfolio. Okay, 40 and 88 lakhs. Let's write here. Okay, 40 lakhs invested. 1, 2, 3, 4, 5. As of now, is 88 lakh is the amount. Portfolio size. 1, 2, 3, 4. Now here are the presumption. Dr. Vikas invested 40 lakhs. As of now, current portfolio is 88 lakh. Okay. Suppose he switch. Now his gain is 48 lakhs here. Okay. Because this is if he sell today, this is his gain. And gain we can calculate. Tax on gain is, you can just multiply here by 0.16 or 0.125. That is a tax rate. So 12.5% of the 48 lakhs is 6 lakhs is the tax. Okay, he tax paid. And now what remains is 88 lakh, 82 lakhs. Now he invested this 82 lakhs in a direct plan here. Okay, and his friend who has this same thing, same amount, but he said, now I want to continue it. So his friend is continuing the same amount. This is the same amount as a regular. Okay, from here story will start. Okay, here let's say one person did not switch, Mr. Regular did not switch, and Mr. Direct switch. Same amount, same invested, same capital gain. Now what will happen? For direct, this is a new capital because 6 lakhs is tax paid. And for regular, you can see this portfolio which is as it is. Now it both invested for next 10 years. And I presume that rate of interest, rate of return is just 0.11% here and 12%. 1% extra. 1% से कितना फर्क पड़ता है मैं दिखा दूं. 1% extra. Here 0.11 means 11%. 10 year. Suppose, then how do you calculate the this is the principal invested in 2025. Regular, you can see this is the same amount here. Regular person has not switched, he is continuing. The direct person switched, this is the starting amount now. Now, when you calculate final amount or after 10 years, it is, we calculate by principal 1 plus rate percent number of years. So here, this is the principal, this is the principal. Rate number of years is the same. We'll just change the rate and do the simple calculation. You can do in calculator as well, and ChatGPT will also do. Now in 2035, this will be the amount. Okay, here I did, this is the principal, 1 plus interest raised to number of years. Okay. Okay, so in 2035, how much amount both got? You can write, check here. Who is getting more? Okay, this is the Master Direct and this is Mr. Regular. स्टोरी यहाँ पे खत्म नहीं हुआ, अभी तो स्टोरी शुरू हुआ है. Okay, now how much will be the gain for the regular person? This is his total amount and beginning amount is 40 lakhs. This is beginning amount. When the regular person has invested this and this is ending amount. So gain will be this amount minus this amount. So his gain is 2 crore, right? And tax on this will be 26 lakhs and final amount will be 2.23 crore. Now the start calculation of the direct plan. This is he got, but now this direct plan principal has become this because he has already paid tax here. So now his gain will be this amount minus this amount. But for this person, this amount minus this amount. You take a snapshot as well so that you get the gain. Tax on gain is this, tax on gain is this. Final amount you can see is this. Mr. Regular is getting 2.3. Now how much difference extra getting by switching? The Dr. Vikas will get benefit. Here I have not added the SIP's added amount. I am just presuming that it is 9,45,000. 9 lakh बहुत बड़ा amount होता है. I am presuming that he has stopped everything. He is not investing further. If he keep investing, his loss will be huge. So the belief that you will lose the compounding by tax payment is wrong. Okay, this is the calculation. Numbers do not lie. People can lie. Okay, so this is people can lie, numbers don't. I will share this Excel sheet. I don't know whether but this is very easy. If you watch these videos, this is step by step. What here I just entered 2 numbers, rest automatically is calculated. Okay, so now someone is 1.1. I'll write here 1.1 CR, 1.1 and 127. So Dr. Raju Joshi, you can save 25 lakhs by just switching. Now let's take questions. Commission is on invested amount or no? Commission is on entire your portfolio and it is deducted every day. Now let's see the magic here. लोगों को मैजिक दिखाना पड़ता है. बॉस कहाँ पे गया? मॉर्निंग स्टार. I'll show the magic here. And by the way, these are not my website. These are the public website. Go to the tools and tell me the any mutual fund name and I'll show the comparison of regular and direct. Someone is asking government bonds, can you invest? See, you can always invest, but it is why to do the all logistics debt fund or access small cap. Okay, select on the SIP calculator, axis small cap. Okay, another axis small, and this is a live data of real funds, not hypothetical. Okay, see the only name difference is now regular and growth. So what I'll do, let's say someone start invested 50,000 rupees per month. Numbers are small. Report date, let's today's date, and starting invested into 2015 and today. Monthly frequently select on the each first month. Commission is deducted every month. Okay, on entire portfolio, whether you are, it is not invested, entire portfolio. Now this is the Axis mutual fund. Okay, so someone invested here 60 lakh. Okay, see this invested amount and the difference. You can check the difference between two. So this is a direct plan, regular plan. Direct plan person is getting, you can see that almost 15 lakh rupees difference, 15 lakh rupees ka difference. just by having the direct plan. Another interesting feature I will show here. So whenever market falls, regular plan falls more because there is money is going out from the funds as well. Whenever market rises, the regular plan rises less than the direct plan. Okay, so you can check this data as well. You can do yourself. What you do, you yourself do the study on this and find it out how much you lost till date and how much you will lose in next 10 years, and just do it. Okay, so let's take some questions. Rolling return we use as a tiebreaker. That means if you want to decide यार which is better, और close fight आ गया तो करते हैं. Let's say यहाँ पे so you can add here and find out the rolling return. Rolling return is nothing but the statistical data of that return in 5-year, 3-year. So rolling return I explained in one of the video. You can use that for the tiebreaker. Now let's take question fatafat. Okay, only questions. 10 minutes rapid fire. SIP monthly, weekly better. Write down monthly is better. Weekly as no use. If you want to, you can have weekly, but monthly is more than enough. How exactly change from the regular to direct plan in one-time investment? That is what I demonstrated. So let's take how to do SIP in ETF. Okay, so in ETF on Zerodha there is a system called as create a basket order, and you can create SIP. Okay. Now the asset allocation in mutual fund, how to decide how many mutual funds we decided. When you do the asset allocation, you make sure that at least 20% is invested into the debt, at least 10% in gold. There are gold ETF, gold Bs. That means if you are investing 1 lakh per month, invest 20% in the debt product, that is debt fund, 20% in debt, 10% in equity, 70% for the in the 70, 10, 20. Let me show you how to calculate as well. Suppose if you when you invest into the mutual funds, you can do the tally of all mutual funds, that how much debt they have. Suppose this is one mutual fund, Parik, and you select equity, how much component it has. You can do the tally of all of them debt. Okay, and based on your SIP, you find out how much they are investing. Let's say you invest 100 rupees in Parik. It may invest 70% equity, 30% debt. You invest 100 rupees in ETF, Nifty Bs. Equity is 100%, 0% debt. You take any conservative hybrid aggressive, where hybrid aggressive might have equity 70% and debt, or here it can be 80%, 20%. Okay, and if you invest into conservative fund, let's say conservative, where equity is 20% or 25%, debt is 75%. If you invest into the debt, purely debt, which invest into the only 0% or here 100%, then you can do the tally of all component. So this, and if it is 100%, so you are investing 500 rupees, and you can just do the division of this with the 500. So your 55% is going into the equity, 45% is going into the debt. This is, you decide how much your equity and debt. In general, we say that your equity should not go more than 70%. Otherwise, portfolio might be more volatile. This is percentage. Okay, you can divide each of funds equity and debt component separately, and you do the tally of your own portfolio. What is average to compare? Average is the average of the category. Okay, we can compare with either benchmark or benchmark or the average of category. My many funds in current portfolio showing negative alpha. Now you got the knowledge. Start at least doing the list and start investing. Okay. One more thing in a drawdown, I think I'll show. Where is that? Morningstar gives one more thing in a word like drawdown itself. Okay. If right, next question is, if fund is not doing well, how long we should wait? Now that's why you have to compare with the category and benchmark for 1 year, and thereafter you can change. Don't change mutual fund every month. Next is, when we sell, the tax to be paid immediately. No, we have to pay tax within that year. For example, if you sell mutual fund today and you got the capital gain, you will have to pay the tax before the 31st of March. My agent invest into, see, always remember, you have to do yourself. Okay, whether tax will be deducted at the time of, no, tax is not deducted at the time of, even if there are some certain rules of TDS, but that is will be calculated in your own ITR. So TDS and tax should not be major concession. So when we do this, okay, so if you see the direct plan, tax is paid here as well as here as well. You may say that the double tax is paying, but the amount is okay. So now this is what you will come across, that you may say that my tax payment is more because I paid here as well and here as well, and the regular plan person is paying less tax because he is paying less to government as well as investor. Okay, so when you change to direct, तो गवर्नमेंट का भी फायदा और आपका भी फायदा. See this is your benefit, investor benefit, and government also getting more benefit. Okay, so when you switch to the direct, this principle becomes a new principle, not the starting amount. So I will not waste more time on the convincing. You have to convince yourself. We'll take the another questions. SIP frequency monthly. Should we invest into Sukanya Samriddhi Yojana out of syllabus? SIP is better on or one-time investment. Write it down. SIP is useful for the volatile asset. Okay, means volatile asset is equity and gold. Lump sum is good for debt. Do not do SIP in debt fund because it is not required. SIP is done to do the rupee cost averaging. What does that mean? I will show that what is rupee cost averaging. Suppose you have we'll select against the same axis small cap. Here I will select. Rupee cost averaging means you get more unit when prices fall. Suppose here you are doing 50,000 rupees SIP per month. Okay, your 50,000 is per month is fixed, but whenever market price goes down, you get more unit. I'll show you here. See, on the 1st of January 2020, I'll reduce the SIP amount so that you can see the real difference. 5,000. When you do the SIP, now you see that when in January 2020, the price of now is 34, February 36, unit you can see 10,000, 24, 248, and then on April price went down. You can see that of 35, 36 to 34, 25, the units are more. So you can see that units are, because when you invest amount, whatever the amount, let's say 50,000, what mutual fund managers does, he find out what is the bhav, that is NAV, Okay, and divide 50,000 by NAV, and whatever the amounts come as a number of unit, and those number of units will be allocated. So what happens when price is like this? Your amount is constant. Then what will change is the number of units. So price is here. Let's say you are getting 100 units at that particular point, but if price went down, here you will get 120. So the idea of SIP is to get more unit when price goes down. What is the idea of SIP? You get more unit when price goes down. So the price, your actual cost of NAV is reduced or averaged out. Okay. Okay. Priya Sathi saying, in mutual fund central, there is option to switch. We can do it, switch from regular to direct. Yes. Wherever there is a switch facility, you do it so that you don't have to withdraw money and deposit, switch. But anyway, when you go from regular to direct, switch is itself is a sale, but logistically it is better, switch. So you will write down, in mutual fund central, there is a switch facility. You can directly go from regular to direct, and that is a better logistically. Okay. Someone is asking, can we convert PMS and direct mutual funds? Now that you decide that there are multiple investment instrument vehicle, we are focusing on mutual fund. What about ELSs? Now ELSs is out of flavor. ELSs is gone now, like no, because tax benefit is now not available in new tax regime. So ELSs will be like Nokia phone. Does switching leads to tax liability? Yes, that is what I explained entirely. Switching will have the tax liability. NFO bought last year. Should we wait or change underperforming? Now, as I mentioned that you should not invest into the NFO, but you already invest. You do the analysis. If you see that it is not performing properly, you can switch. Is it possible to switch from direct funds without stopping the SIPs? Now, this is all depend upon aggregator to aggregate. But I think SIP stopping is necessary. Otherwise, new fresh funds will go to that particular fund. So better to stop SIPs. Stopping SIP should be the first step. In gold, where to invest? Gold base. SGB is now not available too much. I invest mutual fund on behalf of my parent in equity. I am nominee for it. Is this okay? Now it is your financial planning. That's okay. How frequently should we change the mutual funds? Do not change fund less than 1 year. At least wait for 1 or 2 years. If you do mutual fund trading, then that will not be correct idea. Mutual funds supposed to be passive investing, low activity, not the trading. If you are doing trading, then do trading in the stocks. Why to mutual funds? How will be new India consumption funds? Okay. What I suggest that if you are a beginner, you don't go into the fancy names, strategic, thematic, sectoral funds. So that is for the advanced people. But according to me, it is really not necessary to go in a fancy funds. Your objectives of growth will be achieved by small cap, mid cap, large cap, flexi cap. Okay. These fancy funds are just for the getting the new customers on the board, selling the novelty. Is it recommended to invest into salaried persons? Everyone can invest into mutual funds, salary or business person, everyone. Can you make a flow chart and how to stages selecting? Now you have the video. You have to make flow chart yourself. Everything cannot be given ready-made. So everything I shown you, you can watch repeated video, because more efforts you put, more conviction you get. Okay. Otherwise, it is not difficult to give me ready-made, but I'll put something on you. I think we'll stop here. We already crossed the time. Don't invest into NFOs. Don't invest in a mutual fund which has less than 5 years. If I say less than 5 years means new fund is 0 years. So out. Okay. Okay. Thank you very much. We will take, we have already posted a doubt form in the web LMS. You can post doubt, write doubts there as well. I'll answer those doubts in a separate video as well. Okay. Thank you very much.
Thank you, sir, so much for the wonderful session. And thank you all participants for patiently attending.